All right, hello everyone, and yeah, welcome back to a new video. So I just recently finished month 4, and I need to start moving on to month 5. So I'm gonna, continue making these videos as I complete them, as there is a lot, to it. So the very first month, or the very first video, I should say, is about interest rates, or therefore the interest rate triad. He goes over the 30, 10-year, and 5-year Treasury market, and he looks at the relationship between the three. We can use this information with our current or already decided bias and objectives. And what do I mean by that? So if on the 30-year you see price making a higher high, on the 10-year you see price making a high with a lower high to the right of it, so a lower high, high, lower high, and then the 5-year is making a high and a higher high. This indicates smart money participation in the market. And so if I was expecting price to, proceed lower or move lower, then I can, use this information and compare it to something like the US dollar, which is inversely related, okay? Meaning when interest rates go up, the US dollar goes down. So in this case, I'm expecting interest rates to go down, so rightfully I would expect the US dollar to be showing some indication that it wants to move to the upside. Using this information, we know the US dollar is inversely correlated with the S&P and the NASDAQ, and it's also good to mention that he didn't go over futures in that lesson, but like the NASDAQ and S&P, but he did mention the fact that the interest rate market is a futures market. Okay, it is a part of the futures market. All right, so the next thing he went over was external range liquidity and internal range liquidity. He spoke about how price will build orders within an internal range or a range that would be defined from a untested high, the most recent untested high, and untested low. Price would build orders within an order block. So you would see price, trade back to an order block. Order blocks form at consolidation right before the up move. So price returns to that, we'll say in a range, builds in its orders, and it would look to liquidate them. Say this was a bullish order block that we're returning to. Price would then look to liquidate them above an old high, which would be considered external range liquidity. This can be applied to every price swing in price. So the next video, oh yeah, and sorry, because I just remembered it here. He also covered gap risk, which is when price moves aggressively in one direction, and then you see the candle after it like trade back into that range with the wick in itself, but the body of the candle actually closes higher. In other words, it rebalances the prior candle's inefficient range, and the candle afterwards should see a aggressive run up. So just taking note of what gap risk is, okay? I'm trying not to look at my notes here, but one of the things that I'm going to have to do is I'll probably have to watch these videos a few times. I mean, it's not so much understanding the actual concept, it's more or less the criterias. And it's fine, I mean, I'm in this for the long run. I'm sure he's going to continue to go over it, but this is just my current understanding. So moving on, order blocks. That was the next thing he went over. So order blocks, he finally gave us a definition for order blocks, which he hadn't previously. I mean, he explained what an order block was, but it was more defined. He explained when an order block is validated, how to enter off of an order block, how you enter, and he also spoke on risk and how to frame risk with that. All right. Now for these next ones, these are all in addition to that lesson and what he was explaining. These next things are all a part of that lesson. So the first one, a mitigation block. Now I already made a video about this previously where I had illustrated what my visual interpretation of mitigation block is, and it's really simple. In a major to intermediate term, uptrend or downtrend, we'll say in this case an uptrend, you'll have a high, and to the right of it, you'll have a lower high. By itself, it means nothing. But between the high and lower high, okay, there will be a low that forms between those. When you see an aggressive run below that low, price will retrade to it. It does this because large funds or smart money would be trapped in the marketplace with their long positions. And so price will trade back to those levels to allow them to mitigate their orders. And so therefore, we have what's called a mitigation block. So a breaker block is very similar but different, okay? A breaker block is going to come in the form of price action in a major to intermediate term uptrend or downtrend, seemingly that it's going lower. In fact, it's going to create, we'll say, in an uptrend. So we'll talk about a bullish breaker. You're going to see a low. Okay, you're going to see a lower low to the right of it at a previous institutional reference point. So be it a old low, like taking sell side, etc. And afterwards, you're going to see price move up, and it's not going to trade past the high to the left of it just yet. It's going to seem like it's going to continue lower. May even slightly move downwards. But ultimately, it's going to then run that high. So, in that case, you would wait for price to trade the high that would form between the low and lower low that forms after. And that would then be your entry off of the breaker block. The rejection block is also found in major to intermediate term trends. And bear in mind, order blocks form, with expansions. So an expansion and an order block go hand in hand, okay? The rejection block is a little harder for me to find on my charts, admittedly. And all it really is a swing high with a very large wick after an aggressive run in price action. Now, the idea is that when price actually trades away from that, eventually it will return to the rejection block above that high. And so this is one of the ways that we can say or see or view a turtle soup. So we'll see the actual bodies of the candle. We don't even need to see them violated, but we'll see the wicks, trading into the range of the rejection block, which would be the wick high to low, or the close of a bullish candle, close to high. Okay, so we measure that range out, and we don't expect price to trade higher. From that, we would then expect aggressive movement to the downside, and that's what a rejection block is. Now, for the reclaimed ICT order block, I think that's what it was called, right? What is it? What did he say? Let me make sure. Yeah, reclaimed ICT order block. Just want to make sure. So, simply put, the reclaimed ICT order block is just understanding that price is going lower to go higher. As price, continues lower, you'll see these short-term rallies above the down close candles, and then you just mark out the order block. Price will ultimately then create its low, and afterwards it's going to start moving above those levels. And when it moves above, you can reasonably expect price to return to the level that was noted from the sell side, and then afterwards move higher. So it's actual, support, or at one point was support, turned resistance, and price will resist off of that level. Now, the next one, so we have reclaimed ICT, so the next one, propulsion block. So, propulsion block, same thing, formed at a intermediate to major uptrend or downtrend, major to intermediate term trend. Now, the propulsion block will come in the form of a order block being activated, and the run up from the high that activates the order block and then proceeds lower. We then focused on price trading above that new high. When it does, it activates the second order block. When price trades back to that, now second order block forming after that order block, you should see an aggressive run to the upside or downside, depending on what side of the market you're trading on. ICT vacuum block. The vacuum block is a really simple concept. Price will create these different gaps, all right, between the open, high, and close. And what it essentially means is there's no trading in between these candles. So it creates a gap. Now, if we're early in the day, such as London, early London session, early New York session, okay, we can expect that gap to be completely filled in. If we're later in the day, it may not fill in the gap. If we're in, afternoon, Asian session, right, we may see price just trade to the highest down close before it made that gap, in the case of it being, bullish. And it may just rebalance that price range in the form of, returning back or trading the range that wasn't traded, but not fully closing it, and then moving higher. It's one of those things where if I was drawing it down right now, it'd be a lot easier to show you, but just explaining it off the top of my head is kind of hard. But I can see it in the chart, so that's really what matters. Liquidity voids. Liquidity voids can be defined when price moves aggressively from one level. So we'll say it's an aggressive, move to the downside, where we just see this one large candle straight to the downside. Well, trading is only happening on one side of the market in this case. And so therefore, we can reasonably expect price to trade back to that, to rebalance that range before continuing lower, or in other words, fill in that void. Liquidity voids are a internal range concept, all right? And liquidity pools. So what's a liquidity pool? Well, it's pretty much what I had explained before. Relative equal highs, relative equal lows, untested highs, untested lows. It's a pool of liquidity because there are pending orders above and below the market. And the reason it's relevant is price will look to distribute their positions above old highs. In other words, close their positions that they accumulated from a low. And you can use this idea in context with your directional bias and where you're expecting price to go. And what that really means is if I'm expecting price to continue trading higher, if I've seen higher highs and no indication of price going lower, I'm going to look at my chart to see if price trades below a relative equal low. And from there, I can expect price to move higher as long as the underlying context is correct. He also went over, in video 12, he went over what a fair value gap was. So a fair value gap is, say we're just proceeding to move lower. We have candle 1. Candle 1 has a body and a wick. Candle 2, which is the candle after, is an aggressive run. We'll even say it has no wicks, okay? The third candle has a wick as well, but the wick doesn't surpass the low of the first candle. In other words, the actual volume of the candle, disregarding the wicks, there is a gap. And it is a gap in fair value. So price will reasonably look to fill or rebalance that at a later time. It can be in the same session, it can be in weeks, it can be in months, it can be in days. It's just a draw on liquidity or expected price level that you can pair with your directional bias. He also went over divergence, phantoms, and double bottoms. I'm not gonna lie, this is something I also need to refine my understanding on, but I'll explain what it is. Divergence phantoms is the idea that it's a retail idea, which is for people who use the stochastic, okay, which is a momentum-based indicator. They will see like a consolidation, for example. That's like in the example he was showing consolidations. On the stochastic, it's going to look like, oh yeah, there's a divergence. Price is going lower, and on the stochastic, it's going higher. We'll say, all right. This divergence will then trip the unwilling liquidity or retail-minded traders into the market who expect price to go in the opposite direction. So, for example, picking highs and picking bottoms based off of an indicator. Price may, he was mentioning, price may reward them 20, 30 pips. They're not going to close it out then. And then it's going to completely go into the oppositional direction. And the reason why is it's just a mathematical indicator that has no impact on price or how it moves. The idea is very similar for a double bottom. A double bottom is going to happen in the form of two lows, or exactly as it sounds, a double bottom. And retail are going to view these levels, double top, double bottom, as classic support, classic resistance. So they're going to trail their stops right below that. And price, say we're close to an old high or close to an old low. Price is going to just retrace to an order block, and that's going to trip them in. Oh yeah, my trade is profitable. It's looking great here. Then it goes the opposite direction and takes out those pending orders in the market. So he's gone over a lot of different things that I will need to continue to refine my understanding on. This isn't a lesson, right? The main idea here is to articulate the concepts to make sure that I understand them. All right, even if I don't completely understand everything, it's okay. I have plenty of time. It's just to make sure that I understand them. He went over how smart money likes to, they don't just enter their positions into the market all at once. They have to price them in. That's the value of an order block. Also, relative equal highs and lows. You need to look to the left of your chart. You have to see what other liquidity objectives there are. You can't just pick the relative equal highs and say, oh yeah, we're above, we're creating these double tops, double bottoms. Price is going to respect that and continue lower. It's just not how price works, okay? You will be liquidity if you put your stop there, okay? And we know that ultimately these large banks, they're after the large fund traders, okay? Not small fish like me and you who think, or I don't think, but small traders that think they have some kind of impact on price, okay? So anyways, I'm going to continue deepening my understanding. Really what I understand, here in this video, just to conclude, I need to be able to better explain order blocks and the content that was mentioned in that, because it's not just order blocks. He went over a lot of different criterias and other helpful stuff there. For the market maker traps, divergence, phantoms, and double bottoms, I do know there's more information that I can't recall that I need to go through on that. I'm good on the fair value gap, something I've known about and learned a while ago. That lesson was a breeze. Liquidity pool, very standard concept. Also just making sure that you only trade that idea with your directional bias. So I understand that, but I'm good on that. Liquidity pools, understanding where pending orders are. That's really what the lesson's about. Liquidity voids, very simple. Just understanding where there's a void in liquidity, price will trade back to that. Vacuum block, that's more something that I just need to back test and actually see on my charts more to understand. I get kind of confused with like the time frames I should use for these, and like obviously price is fractal, but with some of the higher time frames, it's not as defined as it would be on a lower time frame. And so I find myself like going through the time frame and just like getting confused or just getting mixed up, and that's really just a lack of experience. Propulsion block, very easy, just understanding price creates an order block, returns to that order block, activating it. In between that creates a high, price trades above that high, returns to the low, which was the prior return to the order block, aggressive move higher, easy. reclaimed order block, same thing. I was going through my charts on this dude, and I'm looking at price like that's going higher than going lower right after, and like I was really struggling to understand it, and I kept doing it like I was there for hours, or not hours, but like probably like an hour and a half. I actually tried, and yeah, I need to deepen my understanding on that. Breaker block, easy. Mitigation block, easy. Order blocks, it's a 40-minute video. I don't feel like I'm getting everything out of it. I need to look back at it. Reinforcing liquidity concepts and price delivery, very simple. Internal, external range liquidity, I understand it. The interest rate triad, I understand that, but I also want to deepen my understanding on that. So to summarize, I know I said that before, and then I just pretty much went over everything again, all right? Excuse my ADHD here. But anyways, I want to go back through the interest rate video and deepen my understanding on that. I want to go back through the order block video, deepen my understanding on that. I want to go through the market maker trap videos to deepen my understanding on that. And additionally, I want to go through pools, voids, forgetting up. Yeah, that's it. That's it. I mean, I have my notes, so I'm going to continue referring to those, but we're going to leave it at that.